We're starting to pick up some really interesting negative divergences within the markets. This morning, here's what you need to know before the bell. The NASDAQ, of course, has been the clear winner of markets over the course of the last year. And really, as we've seen this rally from those October lows in the NASDAQ, again, yes, it's been driven by a handful of stocks. Yes, that's true. Breadth has been broadening out, absolutely for sure. That has been going on. But we're starting to pick up some really interesting negative divergences within the markets. And again, we start taking a look at what's happening here. The NASDAQ's been running right along this 20-day moving average in particular from those October lows. It's been a very, very stable advance up to this point, been driven, and again, this is not a surprise, passive inflows into the market. In other words, people buying passive, ETFs, basically just kind of passive investing. That's been the bulk of the flows coming into the markets, not rather than just buying individual stocks or just buying baskets of stocks. Those baskets of stocks are heavily weighted in those top 10 stocks in the index, Apple, Microsoft, Google, Nvidia, etc., which explains this very steady rise in the market, because this very steady rise in the market also looks very similar to the rise of passive inflows into the market. So again, that very much explains that. But here just recently, we're now running back into these previous highs that we saw in January of 2022. So pretty amazing that we had this peak in the market in January 2022. Lots of exuberance, lots of excitement because of all that stimulus money. The market sold off here. We've now rallied all the way back to that peak, completely recovering that without all that stimulus. So again, this has been driven by a lot of exuberance that hasn't been really supported by checks to households and other things. So it just goes to show you, A, how much money is out there just circulating around the economy. But the exuberance that's been pushing these markets higher here, this chase to be in the markets, this fear of missing out, has really been quite extraordinary up to this point. But here's the thing to watch is that we're getting negative divergences now in relative strength as well as in our MACD indicators as well. Market is going up, but you have a negative divergence in the underlying technical indicators. Momentum of that move is slowing down. This morning, again, futures are pointing a bit lower here. And when we look at the markets, this negative divergence is going to have to be corrected at some point. In other words, the momentum, the slowing momentum will be eventually reflected in the overall price of the market. So we're not there just yet, but it is starting to really weigh on this. Once we take out these kind of initial moving averages, importantly, particularly at the 20-day moving average, it's going to be the 50 and the 100 that are the most likely candidates for a correction here in the short term. So again, that could be that decent 3 to 5% correction that we've been talking about over the next month or so. Would not be surprising at all. And again, because of the negative divergences that we're seeing in some of these indicators, certainly suggests that we're likely closer to that than not. And again, that would be completely normal. In fact, it would be healthy for the markets to have a bit of a correction. That'll provide you a better opportunity to increase exposure. But we've been talking about this for a while, and it's not going to happen because the markets just kind of keep going up. And it could certainly do that for quite a long time, but eventually these negative divergences will kind of play catch up with each other. They always do, because these indicators are a function of the price momentum in the underlying market. So again, a bit of a correction here before you kind of get the next advance in the markets. So again, just as I've been saying, I know it's a little bit ad nauseum, we repeat this a lot, but whether it's the NASDAQ or the S&P or whatever, it's a function of those passive flows that have been driving the markets. And if we see a reversal there, you're going to get at least a short-term correction. Again, correction does not mean a bear market. It just means a better opportunity to put money at work on a better risk-reward basis. But that's what you need to know before the bell this morning.